Okay, hello and welcome everyone. On behalf of Questrade, I want to thank you for joining today's webinar. We're very excited to have Michelle Hahn, author, chartered financial analyst, and founder of the SassyInvestor.ca presented for you this afternoon. Before we get started, I just want to touch on a couple of housekeeping. First, today's webinar will be recorded, so keep an eye on your box next week as we will be emailing out a copy according to everyone who signed it. Next, we'll try to leave some time at the end for Q&A. So if you have any questions for Michelle during her presentation, type in the chat window below. I'll ask them on your behalf at the end as time permits. That out of the way, I'll pass the microphone over to our esteemed presenter. Take it away, Michelle.
Great. Thank you so much, Jeff. Thanks for having me here today. I'm so excited to be here. Thank you, everyone, for joining me here today. Look forward to teaching everyone here how to ignite their investing confidence and build a winning portfolio. So a few more housekeeping items on my end, just to make sure we're all on the same page here. So this presentation is for you if you want to invest, but you don't know how exactly or exactly where to start in constructing your portfolio. You want to be more confident with your money so you can be able to self-manage your own investment portfolio, build it and manage it going forward, have money work for you while you focus on your life. That is a big part of the strategy that I'll be talking to you about today. Very important. And of course, you will be building wealth over the course of your life. And while you're at it, have a peace of mind because you're going to really understand what is going on with your money and your investments. So, bit of a disclaimer. So the Sassy Investor, we do not provide investment advisory services, including specific stock advice or recommendations. We are an education and financial planning platform. So that means we offer personal finance and investing courses and individual financial planning for a flat fee, and that means we do not sell any specific, we don't sell financial or investment products like mutual funds or any type of insurance product. So today we're going to be going through the proven and best strategy when it comes to investing in the stock market. So first off, we'll be covering what does it mean to be investing in the stock markets. We're going to be looking at it from a different perspective from what is typically out there. And again, so you become more confident with this process. And then the strategy being consistent, ignoring the noise, adapting, being patient, and thinking long-term. Okay, you're going to be adopting a long-term mentality, watching out for fees, very, very important, and just plain keeping it simple. And then at the end, there is a bonus tip that a lot of people overlook, especially here in Canada. So a bit more about myself before we dive into this presentation. My name is Michelle Hung. I am the founder and author of the Sassy Investor, my self-titled book. My mission is to empower as many people as possible, teaching them how to achieve financial independence and build a lifetime of wealth. So I used to work in investment banking and venture capital in Toronto. I did that for about 7 years prior to getting into personal finances and financial education. I am also a CFA charter holder. That is the Chartered Financial Analyst designation. It's a globally recognized investment management designation, and the Institute holds us charter holders to one of the highest fiduciary standards in the world. That is, we always have our clients' interests at heart first and foremost. And of course, I am a sassy investor, and I'm going to show you how to become one after today. So, getting started with a few of the basics here, like what is investing in a stock? Because I'm going to be talking about investing in the stock market. So breaking it down, what is a stock? What does investing in a stock mean? Well, investing in a stock is simply investing in a company. You're going to become an owner of a company. And as an owner of a company, you are entitled to the profits of the company. And when they're paid out, they're called dividends. And on top of that, you are entitled to, grow with the company, the growth. Okay. And with that comes the stock price gains, capital gains. So these gains are very much similar to the way people make money off of in real estate. Like when you buy a house and the value of a house goes up, you sell the house. Okay, that difference is called the capital gain. Same with what happens when you invest in a stock. So what about investing in the stock markets? Well, investing in the stock markets is simply just investing in a whole bunch of companies at the same time. Okay, so all of these companies, okay, and some more make up the stock markets. Okay, you're going to be an owner of all of these companies at the same time. And these are companies that you're very familiar with. You're already feeding profits to. Okay, so there's Apple, there's Google, there's Amazon, there's McDonald's, Under Armour, like all the foods that you eat, the cars that you drive, the gas that you use, everything you buy, you might as well get some of it back. Okay, I call this taking an interest in your day-to-day life. This is like getting a lifelong discount on everything that you buy. So I'm not asking you or telling you to buy individual companies and pick your own stocks. Most people should not be picking their own stocks. But the easiest way to own a whole bunch of companies at the same time is investing through a fund. Okay, whether it's a mutual fund or an exchange traded fund, we call it ETF for short. So this is how you'll get access to owning many companies at the same time without buying individual stocks one by one. So there are some key differences between a mutual fund and an exchange traded fund, an ETF. And that is, well, an exchange traded fund, it's traded on an exchange, just like a stock. So that means anyone is free to buy and sell them. When it comes to mutual funds, and I'm talking about traditional mutual funds that have been around for a long time, okay, they're typically sold by financial institutions like the banks, and they have a lot of them have restrictions on them, like they require a minimum investment upfront, or a minimum ongoing investment every month. With an ETF, way more flexible. You can actually just buy one ETF. Okay, there's no minimum. You can invest, $30 in an ETF if you want. So that's one key difference between an ETF and a mutual fund. I'll discuss another important difference later on. But for now, we want to be investing in ETFs. So what is this overall strategy? As mentioned, okay, being consistent. That is investing consistently and not timing the markets. Okay, you got to ignore the noise. So things like news, economists, social media headlines, these professional opinions out there on business news or random tips from random people, okay, that is tuning out the noise. You have to think long term. I always say, slow and steady wins the race. You're gonna hear me say that a lot. Okay, so long term, as in think 10 plus years. And of course, you have to watch out for the fees because these things can really eat into your returns a lot. And I'll show you why that is the case. So being consistent, okay, that means you're investing your money every month or every quarter, no matter what happens, okay, whether it's an election year, whether it's a recession, whether it's a depression, okay, those are actually the best times to be putting money in because you're buying in at low prices. You're averaging your cost base down. Think sale. Okay, the stock market is one of the very few things out there where people run for the hills when there is a sale. Okay, this is when people are fearful. But as Warren Buffett says, be greedy when others are fearful. That means take advantage of downturns in the markets. And being consistent also means you have to ignore the noise. Okay, that means whatever headlines are showing up on your Facebook feed or hitting the newspapers, just ignore it. Okay, so Remember when Bitcoin was so hot? Like everyone was asking me about cryptocurrency and investing in Bitcoin and all these other wild virtual coins. Okay. Stuff like this, while it may sound tempting, because the media will keep sensationalizing these products. Okay. And they're just going to keep taunting people, have these headlines and stories on, oh, look how high in price these things have skyrocketed. And they get you emotionally because they just create this FOMO effect, okay, that can actually destroy your wealth. You can lose a lot of you can lose a lot of money when you invest in these fads, okay? Their job, by creating these stories, they kind of just get people to invest in these things. It's not right for them. And worse, some people actually place too much money on these bets. So when something is hot, media will not stop talking about it. Okay, it's their job. Their job is to talk 24/7, pump out content. They have zero interest in whether you lose all your money or make a ton of money. In fact, they'll probably love it when people lose a lot of money because then they'll have something to write about. They'll have a story to tell. So don't fall into that trap, okay? Don't be that story. Don't be that guy that maxed out his credit card to buy Bitcoin at the peak. And that is a true story. So a lot of people fall into that trap simply because, well, they don't have an investment strategy. They don't know what to do with their money. They just invest in whatever is hot and they think very short term, like instant gains. So when you're investing, you have to think long term, okay? Think of it as you're not touching this money for at least 10 plus years, okay? Remember, slow and steady wins the race. I always tell my clients and my audience, your investment portfolio is not Amazon Prime. It's just not going to show up in 2 days or even a day for that matter. Okay. It is a marathon, not a sprint. Okay. You're going to be watching your money grow over the long term, which means you're not checking on your portfolio every day. Okay, that's like watching water boil. Water never boils while you're watching. Okay, you have to actually just literally step away and do something else, and then it'll boil for you, right? Okay, same with your investment portfolio. You're not checking it. You can invest every month or every quarter, putting money in, and before you know it, okay, one of the most common things I hear from my clients, from people that invest, is, oh wow, I can't believe I've made this much money. I can't believe I've put away this much money. That is a result of being consistent and not worrying about your investments. Now, you're probably wondering, aren't the stock markets risky? Don't people lose all their money in it? Because we always hear about people talking about that. Well, you only hear about that because there's always that one friend out there who's like, well, I know someone whose family lost their entire savings in the stock markets. Okay, when in reality, they should be saying, they know someone whose family lost their entire savings in one company they invested in and it went bankrupt. It was probably Nortel. It was recent, maybe it was Sears. Yeah, the stock markets, they go up and down every day, every week, every month. They fluctuate. That's the volatility. That is the risk when you're investing in the stock markets. But over the long run, it has gone up. Remember, slow and steady wins the race. The markets have recovered from every recession, every depression, every election, but never in the history of the stock markets has it ever gone to zero, nor will it ever, unless, of course, something crazy happens like a zombie apocalypse. Okay, if that's the case, we'll all have much bigger problems. None of what I'm saying would matter. If one, maybe two or five companies go bankrupt, that's fine. Okay, it happens. It's part of business, it's part of life. Okay, but it's when every single company goes under at the same time, then you'll know there's something wrong out there. Okay, that's when we'll all have a cause for concern. Because remember, as long as we're eating, going to work, sleeping, spending money, anytime you pull out your money and buy something, companies are making money. And when companies make money, you as an investor and owner of these companies will make money. Remember, profits and dividends. This is the chart for the US and the Canadian stock markets. Okay, so specifically the S&P 500 index and the TSX composite index. So the TSX composite index is just a group of 240 of the largest Canadian companies that are publicly listed. Okay, the S&P 500 index is a group of the 500 largest US companies that are publicly traded. So when you hear people refer to the Canadian markets or the US markets, they're generally referring to these indices. So the US and Canadian stock markets have averaged 8 to 10% per year over its entire history. Okay, and that's a straight line average, meaning in 1 year it can go up 15%. The next year it could be down 20%, and then up 4% the next year, and then down 8%. When you average every single one of those numbers up, you get 8 to 10% per year, 8% for the Canadian markets, 10% for the US markets. So over here, 2008, 2009, this was the Great Recession, 2008 and 2009. Right here in 2000, this was the dot-com bubble, okay? From the worst, okay, from the peak to the bottom in 2008, 2009. So if it just so happens that you've invested all of your money at this point in, say, an S&P 500 index ETF, okay? Let's just say you inherited some money, you dumped everything in at this point, you would have watched your portfolio go down 38%. And that's on paper. So if you actually sold it, you would have locked in those losses. But if you didn't and you hung on and you continued with your strategy, you would have made all of that back and some more. So we're about right here today. So remember, you don't actually lock in your losses. You don't actually lose money until you hit the sell button and you realize those losses. It's just like a house. You don't actually make money off a house until you actually sell it and that money is in your bank account. Okay, same thing with your investments. Yeah, it sucks that you see this paper loss on paper. When you log in, you're like, oh, my portfolio is down. But that is part of it. But remember, you have to wait it out. Okay, and it's these points in time during these recessions, okay, when people complain about losing money and why they see investing in the stock markets as risky, because they see their actual portfolio in decline. But remember, as long as you're continuing with your strategy, investing in these downturns, okay, remember, these are the times when stuff goes on sale and it's your chance to average your costs down. You wait it out, you'll see some great things happen to your portfolio. Okay, remember, averaging down, think sale. It's like when you have to buy toilet paper. Not if, it's like when you have to buy toilet paper. Okay, you have to buy toilet paper forever. But imagine the cost of toilet paper fluctuating every month. Okay, 1 month it could be $20 a pack, I don't know, and in another month it could go on sale and be $10 a pack. But that's when you go nuts. Right? That's when you load up, because either way, you still need toilet paper. And if you buy more toilet paper when it's on sale, you're going to see that your average spend on toilet paper goes down because you're buying in at these lower prices. So again, when I say you have to apply your strategy to be consistent and adapting a long-term mentality, this is why. You have to give it time to weather the storm, these fluctuations in the markets, and be able to ride out these times. That's why long-term thinking, long-term mentality is really important. And the longer you hold on to your investments, you increase your probability of making money. So this is the chart. This is a chart that Dimensional Returns created for the S&P 500 index, so the US markets. And this goes back from 1926 to 2015. It should apply to till today as well, because we are up from 2015. So This is a chart on the probability of making money if you were to be, buying and selling an index fund during over this time frame. So let's just say you were buying and selling this fund on a daily basis every day. Okay, any point in time during this period, if you were doing this every day, your probability of making money, okay, probability of making a positive return was 54%. Okay, so that's like that's a flip of a coin. Okay, you might as well go to the casino. But if you do it less often, say you do it on a quarterly basis, you're doing this, you're buying and selling, you're doing this 4 times a year, okay, that probability of making money, it goes up to 68%. Now, over a 10-year period, as you can see, the chances are much, much higher, okay, significantly higher. So any 10-year period, okay, that you were buying and holding your investments, you hold it for 10 years, the chances of you making money, earning a positive return was 94%. And over a 20-year period, any 20-year period, that means whether it's 1926 to 1946 or 1990 to 2010, any 20-year period that you would have hung on to this index fund, index ETF, index fund, the chances of you making money would have been 100%. Okay, you want safe? People are always asking me, what's a safe investment? And I go, you want safe? You adapt a long-term mentality and you hang on to your investments. Okay, this is exactly why it's very important to hang on to adapt a long-term mentality. And it's not chump change we're talking about. Okay, these are the effects of investing. So let's just say you have $10,000 to start with. Okay, $10,000 cash, you want to invest that money. And then going forward, you want to continue to invest. You're putting in $500 a month. Okay, so that's $6,000 a year. Say you do this for 30 years. Okay, so after 10 years, you would have put in $70,000 of your own money. And let's just say over a 30-year period, assume a 7% return, annual rate of return. So straight line average, okay, 7%, and assuming a 0.17% MER fee. So I'm going to talk more about fees later, but basically anytime you invest in a fund, an ETF or mutual fund, they charge you a fee for having your investments in that fund. So let's just say in this example, the fee is 0.17% per year. Now, over 10 years, your gains would have been about $31,000. There's your six-figure portfolio. Now, over 20 years, okay, so you would have just almost doubled the amount you've invested from 10 years ago, so 130K. Your gains would have gone up almost 5 times, okay, even though it's just about a double, okay, of the amount of money you've put in, your gains have gone up almost 5 times. Your portfolio would have gone up almost 3 times, so more than double. And over a 30-year period, you would have almost tripled the amount of money you've invested, okay, but your gains would have gone up 15 times, almost 15 times. Your portfolio would have gone up over 6 times. Okay, we call this the power of compounding. When money makes money for you, okay, and all the money that you've earned on those investments, you reinvest that, and that makes money for you, and you keep doing it, okay? Compounding return. And as you can see here, you kind of hit a critical point and your money just grows exponentially. And just like Albert Einstein says, okay, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And that is what I mean when we talk about fees. This can easily work against you. Okay, fees will compound as well. So that's why you have to be adamant with what you're paying, the fees that you pay. So When I'm talking about these fees, I'm talking about the MER, that stands for Management Expense Ratio. It is an annual fee you pay for a fund that you're investing in. Now, the average MER fee in Canada is about 2.23%. Okay, doesn't sound like it's a lot, but it's actually a lot of money. We pay one of the highest MER fees in the world, unfortunately. And I'm going to show you why, how 2% can add up to so much money. It doesn't sound like a lot, but it is. So in this example, similarly, with the previous example, you start with $10,000. Okay, and every month you're investing $500 to your investment, so that's $6,000 a year. Okay, now imagine you invest this money in a mutual fund that charges 2%. Okay, so we'll round down 2% per year on your total investments. They're going to take 2% of your the total value of your portfolio. Okay, whether it's a good year, whether it's a great year, whether it's a terrible year, they're taking 2% per year so long as your money is invested with this mutual fund. Now, assuming an average return of 7% per year, again, straight line average, straight line number, after 10 years, you would have paid over $11,000 in fees. Okay, that's about $1,100 per year on average. Over 20 years, that amount is almost $50,000 in fees. Okay, which is insane because if you think about it, that is over 8 years worth of money that you're putting in. Remember, you're putting in $6,000 a year, okay? After 8 years, it's $48,000, okay? 8 years out of the 20 years you've been putting your money into this mutual fund, 8 years of that money would have gone to fees, okay? That is insane. Now imagine what that amount is over a 30-year period. Yeah, that amount is over $138,000. Okay, that works out to be about $4,600 per year. Because remember, the bigger the size of your portfolio, clipping 2% per year will really start to add up. So again, you have to be adamant on the fees that you pay. So mutual funds, these traditional mutual funds, they are expensive. Good thing is these exchange traded funds, okay, nowadays with these ETFs, they are a fraction of the cost. And I'll show you an example at the end on what a fraction of the cost means. Okay, and I'm going to touch upon that after this one last thing I want to talk about, and that is the bonus tip on diversifying geographically. So what does that mean? Well, that just simply means, okay, invest outside of Canada. So imagine this. You live in Canada, you get paid in Canadian dollars, you work for a Canadian employer, okay, maybe you get stock options as well. It's a bonus from your Canadian company. So maybe you'll have some concentrated positions, some concentrated stock. Now imagine your portfolio is in Canadian funds only, okay, because you're thinking, oh, Canada is safe, everything is safe here, okay, that's not the case, okay, and imagine you're still rooting for the Leafs, okay, this is a huge bet on your home country, a huge bet on one country. No country is immune from an economic downturn, okay, but also every country's economy is different. Canada is very resource heavy, okay? We are a very resource driven, we have a very resource driven economy, okay? What do we have? We have our big banks, okay? The RBCs, TDs, we have our telecom companies, Bell, Rogers, TELUS, we have a lot of resource companies, okay? Oil and gas, mining and exploration. It's very different from the US, okay? What do they have? They have Apple, they have Amazon, they have Facebook, okay? All those tech giants, they have banks as well. They have JP Morgan, Wells Fargo, Goldman Sachs, okay? They have companies like Walt Disney, Walmart, okay? Very different economy from Canada. Their economy, okay, is 10 times the size of ours. Okay, then there are countries like Belgium, France, Germany, Hong Kong, Japan, Korea. Okay, these are developed nations with a lot of solid companies that are based there. And we're familiar with them. We buy from them. Nestle, Toyota, Samsung, LG, we buy those products. Okay, we embrace traveling to those countries as well. So why not invest in them as well? And all of this can be easily done with a super simple portfolio. So this is just an example of a portfolio I constructed with 2 ETFs. So assuming it's 100% in stocks and equities, and let's just say you want to allocate 30% to Canada. Okay, you gotta support Canada, of course. Okay, home country. And this example I'm using is XIC. Okay, this ETF is the TSX Composite Index that I showed you earlier. And the fee, the annual fee is 0.06% per year. Okay, so legit a fraction of the 2% average MER that Canadians pay. Okay, so this one's 0.06%. It is very low. And then let's just say you want to invest in everything else. Okay, so there's an ETF out there. It's XAW, and it has, investments in the US, Japan, UK, China, France. So these are the top 5 countries. And let's just say you want to allocate 70% of your portfolio to that. Okay, the MER on that is a little bit higher. It's 0.22%, but still, that is still a fraction. That is like 10% of the cost of the 2.2% average that Canadians pay on their funds, typically the mutual funds. So when you calculate it all out, the average MER, the weighted average MER on this super simple portfolio is 0.17%. Okay, on a $100,000 portfolio, that works out to be $170 a year. Versus if it's 2% per year, that is $2,000 per year. So obviously, we all rather be paying $170 versus $2,000 per year, and that amount will go up when your portfolio doubles or when it triples. Okay, so with this portfolio, the effective geographic exposure you get 30% Canada, and almost 40% US, 6% Japan, UK, 4%, 3% China, and 2% France. There's a bunch more in this ETF. So 2 ETFs can get you so much coverage, very easy. And this is how you can get started, construct your portfolio like this. Again, very easy. 2 ETFs, you get your low MER and you get the diversified geographic exposure that's very diversified. So just to summarize everything that I just shared with you today, okay, investing in the stock markets, remember, it's like taking an interest in your day-to-day life, okay? It's giving yourself a lifelong discount on everything that you're already buying. Remember, anytime you pull out your wallet and you buy something, companies are making money, and as an investor of those companies, you are making money as well. Okay, you have to be consistent. Okay, remember, you're investing every month or every quarter, no matter what happens, whether it's a recession, a depression, or an election. Okay, it doesn't matter who's in charge. It doesn't matter who's running the US. It doesn't matter who's running Canada. You have to be consistent. That also means ignoring the noise, headline news, fads, social media, anything that's hot, just ignore it. Okay, so you got to be patient and think long term. Slow and steady wins the race. And most importantly, watch out for fees. I showed you how that can really eat into your returns. And of course, just plainly keeping it simple, just like the super simple portfolio. You get, a low fee portfolio. It's simple, and you get the geographic diversification. So when you pull all that together, you have a pretty solid portfolio to begin with. Now you probably have questions like, well, Am I only going to be investing in the stock markets? What about bonds? Okay, what if I don't want that much volatility in my portfolio? How does that come into play? Where should I be putting these investments? RSPs or TFSAs? What happens when I max those out? Well, unfortunately, I can't discuss all of that in one afternoon, but if you want to dive into details a bit more and learn how to manage your portfolio over time, because as you move up in life and go through different phases in your life, your portfolio and financial plan will change as well. So if you want to know more, if you want to know more and really want to step up your investing game, I am offering a program called Fast Track Your Financial Freedom. It is a 3-day intensive program starting September 11th, and it runs 3 days in a row. Okay, so it's back to school for everyone, and each class during those days will be approximately 2 hours each. I haven't determined the time yet. It's going to be a vote for all the students that sign up, and the most popular one time that gets voted, that's what we'll go with. So it's TBD for the time. But for these classes, you're going to learn how to easily build a portfolio like a professional. You're going to receive the expert guidance and tools you need to confidently manage your money easily, effortlessly. Okay, you're going to walk away with an investment strategy and the exact steps you need to build your plan that reflects your goals, your lifestyle, and your risk appetite. So this is all for you. Okay, it's a practical experience where you're going to go from I'm not sure what I'm doing to okay, now I know exactly what to do now. So some of the core topics that we'll be covering, okay, on day one, mindset. This is so important. I always say you are your own worst enemy when it comes to investing. And when you have the right mindset, I call it the winning mindset, this distinguishes you from the chronic losers in the investing game. So you're going to be on the winner's boat after this. We're going to cover more investment basics, okay, what you need to know from the bottom up, just like, what is a stock? I mentioned this earlier. We're going to know what is a bond and, what's the differences between stocks and bonds? How do you make money with them? You're going to know what you should be investing in. And of course, you're going to be building that portfolio of ETFs, okay? And it's going to go a little bit deeper than the super simple portfolio. So you have a little bit more control over the geographic exposure, and that also means your fee, your MER can come down as well. And that also includes if you have mutual funds that you want to transfer out of and into ETFs, I show you how to replicate a mutual fund. And then on day 2, we're going to look at the types of accounts and taxes. So, TFSAs, RSPs, what's the difference? Where should I be in? Okay, taxes are your biggest bill. You want to minimize it, okay, and be tax efficient with your investments. Different products, different investment products have different tax consequences. So you're going to be learning about that. And again, practical experience, we're going to be executing, okay? Execution is key, actually doing it. You're going to be navigating websites, okay? The forms that you're going to need to fill out, and using calculators to build your plan and portfolio. So when you're navigating these websites, I'm going to break everything down for you, on like an ETF website. Okay, so if you've been on a few of them, you're going to notice there are a lot of acronyms. Okay, we've covered MER. I've briefly mentioned S&P, TSX, but on there you're going to see like FTSE, MSCI, NAV. What are all these acronyms? But rest assured that you're going to become familiar with all of that terminology, what it means, and the next time after you do this, you're going to be looking for your own ETFs and you're going to know exactly what all of these mean. And with that, that just gives you way more confidence with this investing process. And that includes after you become very, very familiar, naturally, you want to build around your core. Okay, that means that's going beyond the bare minimum, discovering other investment products out there, potentially ones that, could reflect your interests or core values. So, for example, are you interested in socially responsible investing? Yeah, there are funds out there that invest in companies that are environmentally friendly, that are socially responsible. There are also funds out there that are very sector specific. So, what are you interested in? Do you believe in artificial intelligence, cybersecurity, marijuana? There are funds out there that cater to these sectors. And, if you're in Vancouver or Toronto, have you always had an interest in real estate? You want to invest in real estate, but you feel it is really out of reach for you. Yeah, there is a way to invest in real estate without directly investing in real estate, okay, without directly buying a house or a property. So we're going to be covering that on day 3. We're going to wrap everything up. Any questions you have, anything you want me to go over, any Q&A, this is the time to do it. But of course, you'll have access to me during and after this program. And as a bonus for signing up for this 3-day intensive program, you'll get a lifetime membership, lifetime access to the Sassy Investor Online Academy. So here for now, we have 4 complete courses, starting with Getting Intimate with Your Money. That's a personal development money course. Personal development and money relationship course that I've created. Take Control of Your Finances. That is all about saving, debt repayment, and budgeting. And the Wealth Builder, it's a bit similar to the 3-day intensive in terms of the topics that I cover, but I do cover a little bit more. It's a really fun course. There are a lot of fun, cartoonish videos and some quizzes that will really help you kind of retain that knowledge. You can dive in there and go through a few topics that aren't covered. So this is a fun one. And the other talk, it is a couples course on money management. So if you need to have that talk with your partner when it comes to money, this is the course for you. And as being a part of the online academy, you'll get, I bring in guest experts and I'll have various tutorials on, different financial and investing topics. And I also provide financial planning tools to help you reach your goals. So if you're asking yourself, well, I want to retire at 55 years old with $2 million in my portfolio, in my bank account. How do I do that? Okay, well, putting numbers to your goals would really help. And that will be the difference between not reaching your goals and actually reaching your goals, is to plan it out. So these are tools that financial planners use. You will have access to this. So all of this is the cost to join my lifetime academy. It's actually $497, but you get this for free as a bonus for signing up the 3-day intensive program. And another bonus I want to throw in there is my Freedom Within a Budget kit. So this is all about budgeting. If you want to find ways to save more money, or you need to, eliminate some debt, this is a plan that I give to all my clients. It gives them the freedom and flexibility so you can save at the same time without blowing your budget. So it includes an easy to follow, stress-free weekly spending plan in printable PDF format, and also a downloadable spreadsheet. And included with that is also a digital money planner to help you keep track of your day-to-day spending. It's a $47 value, and you'll get instant access to this when you sign up for the 3-day intensive program. So just to recap everything, the 3-day intensive program, you'll get 3 classes, roughly 2 hours each class with replays. Okay, you'll get access to those replays forever if you cannot attend those classes, or if you want to just revisit and rewatch the classes. Tools and resources provided during and after the program. You'll be a part of my private Facebook group where we can continue the discussion, ask questions, and go through this process together. You don't have to be alone. And as mentioned, you'll get the bonuses, lifetime access to the Sassy Investor Academy, and the freedom within a budget kit. You'll get instant access to that when you sign up. So all of this, okay, will cost you, your investment is $327. I have an early bird special going on. It's $447, but because you've attended this webinar, I want to give you an extra discount, but only for the next 48 hours. So make sure you use coupon code Questrade when you check out, and you will get all of this for $327. That's Canadian dollars and tax included. So are there any questions? That pretty much wraps up everything I have to say today.
Perfect. Great. Thank you so much, Michelle, for this very informative presentation. We did have a couple of questions come in here. So first up, there were a couple of viewers who already started index investing, it looks like, and they were asking, they've been doing it for a couple of years now and it's going okay, but is it true that most returns from index investing would come after a market downturn? Or another person asked it a different way, saying, as an index investor, should I be hoping for the market to turn lower? Could you comment on that at all?
Sorry, can you repeat the last part? You kind of cut out there.
Sure. I just, they said, as an index investor, should they be hoping that the stock market actually goes down so that later, over the long term, to make more? Is their understanding correct?
Yeah, because if you've been investing the last couple of years, we've seen it just go up and up and up, right? And yeah, like I said, embrace these downturns if you can, load up for when these downturns happen. But again, even if you are consistently investing, you're ignoring whether it's an up market, down market, when you're investing consistently, okay, you'll still average like a good return. Remember, like over its entire history, the markets have averaged 8 to 10% per year. That's a straight line average. That includes, the big rises. That includes like the big downturns, right? So that's what I mean when I say straight line average. So yeah, like I always, enjoy, as sour as it sounds, I'm like, I can't wait for the markets to go down because that's when I start loading up. And of course, you're averaging your costs down, so you'll see the returns be reflected in that, especially over a longer period of time. A little bit hard to gauge after a couple of years, but over a longer period of time, you will definitely see the results of that.
Perfect. Thank you. Along a similar note, I think this is a question about rebalancing of index funds. So someone asked, why do stock indexes tend to go up over time when companies are going bankrupt? So for example, you mentioned Nortel and Sears and some others, but the overall market and the index is trending up. So I was just wondering if you could shed some light on the kind of mechanics there.
On why, like if companies go bankrupt, the markets still go up?
Yeah, correct.
Yeah, because they remove these companies out of the index. So the index traders like S&P or Dow Jones, they'll just simply, like if they hit a certain point, like in the phase of the business, they'll just remove it. So it kind of does skew, it, but for good reasons, right? They're like, well, you're not. They're pretty much saying, okay, well, you don't belong in this index anymore. So they just remove it. So they're always like rebalancing, they're adding companies to it, they're removing companies from these indices.
Perfect, great. So yeah, indexes aren't necessarily a static thing. They're changing or rebalancing.
Exactly. New companies surface, like companies grow. So very few companies that have actually lasted a very, very, very long time.
Perfect, thank you. We also had some questions about bonds and different types of assets, but I think visitors can follow up with you after and check out your website and course to learn a little bit more about that. The last question I wanted to ask that came up was, it sounds like you work with new investors quite a bit. What's the biggest mistake, that you see new investors make that our viewers here should maybe keep in mind?
The biggest mistakes, new and well, well, to be honest, a lot of people like we all make mistakes, right? But the biggest mistakes when it comes to investing in general would be the fees. Um, so they'll often go to the banks and they'll buy a mutual fund or they come to me, they're like, yeah, I've invested in these mutual funds a long time ago, but I've just left it there, and then they kind of want to start fresh, but they don't do anything with it. They don't do anything to take them out of these high cost mutual funds. So that's one of the big mistakes. Again, that's why I really emphasize the fees that you pay. And it's easy to just let your money sit there because it's just, it probably would have grown if you've invested like 5, 10 years ago, but still going forward, um, the annual fee that you're paying, it will add up to a lot over the long term. So, um, fees is one of them. Not getting started is another one. A lot of procrastination that I see from people when they do approach me. They're like, I want to start investing, but then nothing actually happens. Which is why, like, I created this platform. It's because I want you to take action. I want you to execute and actually and do the actual like the process, like execute just execute, right? Going through the process of actually buying an ETF, going through like practice accounts. That's what I do. And then the third one, another mistake will be not investing consistently. Some people, they just give up or they're very sporadic. So being consistent is really important. And yeah, I get it. If you like miss a month or two of your investments, if something happens, you lose your job or there's an emergency, that's fine, right? But it's important to kind of maintain that. So yeah, these are some of the mistakes that I see people make.
Perfect. Thank you. No, that's very helpful, Michelle. We are coming up on the lunch hour here, so just to respect everyone's time, we'll wrap this up now. I want to thank everyone for taking the time to attend today, and thank you, Michelle, for taking the time to share your expertise. I really enjoyed it, and I know everyone else enjoyed it as well.
No problem. Thank you so much for having me. Can I just quickly enter in the link for the program in the chat
Yeah, for
box?
sure. You can just add that to the chat box. And then as a reminder to
Thank you.
everyone listening in, we will send out the recording probably towards the end of next week. And we'll also include a link to Michelle's program in that as well. So keep an eye out for that probably next Thursday or Friday. And thanks again very much for attending. That concludes today's webinar.
Great. Thank you so much.